the central planners and the central banks literally can't afford $20 oil. And the problem with $20 oil is a banking problem. And we know the banks are large shareholders of the Federal Reserve. And $20 oil is a very, very large problem for inflationary expectations, which is what the Fed and the government need.
Investors today face an unprecedented level of risks. Currency risk, major market indexes, natural deflationary forces, and endless money printing from central planners. Meanwhile, most savers today are being told to stay the course, with high commission products and risky investments dependent on fraud. There is another way forward with peace of mind investing, a financial strategy with 4 key principles: safety, income, currency risk, and finding cash-gushing value investments. Learn more about these financial strategies at fmtadvisory.com/income.
Hello, everyone, and welcome into CrushTheStreet.com. We got a returning guest today, the week of a potential rate hike decision. His name is Nicholas Green of FMTadvisory.com, and he's been one of the most spot-on guests that I've ever had on the show. His analysis from the Dow to gold ratio and, where we would likely see this go, and basically calling the bottom in oil this year. Right now, we are seeing oil going higher, and I'd love to get an update from him on this. And even the stocks that have been mentioned on this show going higher in this volatile environment. Nicholas Green has been very, very spot on, and I encourage you to watch some of our previous interviews and get to know him, because he's a valuable resource for people who want to be educated on the economy. So Nicholas Green, thanks so much for joining me today.
Hey, thanks a bunch for having me again, Kenny. Love your program, and it's a pleasure to be here.
Absolutely. Nick, last week we saw the 7-year bull market anniversary. And this is kind of interesting because we have had a lot of volatility, and they're still calling it a bull market. And quite frankly, we've seen the stock market rise pretty substantially. And if you look year to date, starting January 1st of 2016, where we saw those big drops, we've almost recovered to where we started off the year, not to 2015 highs, but we've almost recovered to year to date levels here. And we're right now doing this interview, we are in the week of when the Fed will likely make a decision on what they will do with the rates. And last year they indicated that they want to raise rates. And I'm curious, with Janet Yellen being a Democrat and the presidential election coming up, what are your thoughts with all of this going on, with what we are going to see with the stock market and then interest rates?
Well, yeah, those are some loaded questions. Let me just start off with the stock market rebounding from February 11th and the lows. When you look at the markets worldwide, a lot of things have happened, and one of them is corporations were in their earnings period, which means they were in their quiet periods, and they can't buy back their own stock during that period. And so as you entered, the year 2016, the stock buybacks were sort of taken off the table a little bit, and the Fed on top of it had just raised rates in December. And so that caused the tremendous volatility in January, which caused a big downturn. And on top of it, you had energy prices hitting the complete floor. And I believe that's around when we did our last interviews, when energy was around $26, $27 a barrel. And I said, a lot of the things going forward rest on energy. The energy prices and the spot price of oil being so low was a huge thorn in the side of central planners and central banks around the world, because the energy credit on banks' balance sheets was starting to hemorrhage really badly, and it's still not doing great, but it's gotten a little more quiet as oil's gone back up, and you're starting to see some some enormous upswings in the price of oil companies. And so you've had energy rebound, you've had corporations going back to the markets and buying back their own stock, and the quarter basis point rise has been sort of slowly forgotten since December. But those are the things that are really off the February 11th lows, where I think up until the last couple of days, I think oil was up 47% off its lows, or somewhere right around there. And the market has really followed, because at the end of the day, credit is the lifeblood of our monetary system, and without credit, everything dies. And so, with energy hemorrhaging on banks' balance sheets, the debt, and then you had the quarter basis point rise, and you had corporations not buying back stock. Those things cause all the volatility, but it's the same things that help us roll it forward. But the other big thing, so you had those things, corporations not buying back their stock, you had energy being so low that it was causing havoc. But then the other big thing is Trump is just gaining all this momentum, and the momentum he's gained has been enormous. And so that's not a happy sight for our own Federal Reserve, which is a Democratic made-up body. And we know that Trump wants to audit the Fed. He's been audited 12 years in a row, and he would like the Fed audited. And we know the Fed wants anything but an audit of what they've been up to, and an open book for all Americans to see what they've been doing, because gosh only knows what they've been up to. And so leave it to Trump. As he leads these polls, it becomes even more critical for the Fed to keep things rolling along, propped up, energy heading higher, stock markets from collapsing, because, there's virtually no way Hillary or Democrats or the incumbents get back in there if you have things crashing all over the, global markets. And so that's where we are, and that's where we are at the moment.
So, excellent analysis there, Nicholas. Nick, so if the markets are somewhat stable going into this week's Fed meeting, with energy rising, the stock market's not, doing what they were doing here in January, is it likely that they will continue to raise rates as they had originally intended when they initially rose the Fed funds rate in December?
I have no idea what the Fed's going to do, and it's a great question, because it's obviously it's a month where they'll decide to raise them or not any further. And China's also gotten really quiet in all this. Remember, during a lot of the volatility, it was China was hitting the news in a big way with the yuan falling against the dollar, and the Chinese pulling out enormous amounts of U.S. Treasuries out of our marketplace, which was, we've also talked about that as the reverse of quantitative easing, is when, you have an entity like China, which was our largest U.S. Treasury holder until the Fed, counts them. But that was a reverse QE. But all of a sudden, China's gotten really quiet. And the problem is that for the Fed, I think they're sort of in a pickle. And if they raise interest rates, that could cause the avalanche of the Chinese having to pull more treasuries out, just because based on the price parity of the yuan with the dollar. And that could cause, more market problems. But it's really hard to say, because the last thing the Fed wants is market turmoil. The last thing they need is market turmoil and deflation transpiring. So how the Fed handles this next interest rate hike is anyone's guess, but it's going to be very, very curious to watch. It's one of the reasons why, if it wasn't for the Fed being sort of stuck in a pitfall of, trying to remain credibility, because when you look at things, there's virtually no reason why they shouldn't be able to raise rates again. They have unemployment under 5%. Core price inflation's ticked up a notch. You have oil starting to rise again. You have markets near record levels, and those types of things. But on the other hand, if you look at the real economy, things are sagging. And even in Buffett's annual report, in an interview, he even recently said, if anyone didn't know this, because a soft patch in the real economy. So to me, the Fed is an interesting precarious situation, and I don't want to predict what they're going to do, but it'll be interesting to see what they do.
Yeah.
And it's good to be, as a money manager, which is what I do, it's good to be nimble, and it's why I'm definitely not all in, even though I believe at the end of the day that Fed will do what they need to do to try to keep things moving along, at least up until the election. But since I don't know, I'm staying balanced and have a good chunk of cash and ready to deploy too.
Nicholas, getting to oil, Iran announced that they will continue to increase production to an estimate of 4 million barrels of oil per day here until they cap it. And they want to take it to where they saw the actual peak back in 2008. And a year ago, WTI actually rose 41% in a 35-day period from $43 to almost $61 per barrel before falling to a new bottom of $38 per barrel in late August. And I'm wondering if we are going to see the same thing here with $26 oil now going up to $37. I think we're in the $36 range right now. If we are likely to see that just be a short-term rally before it goes below 26 and into the lower 20s.
I think it's a very large probability we don't see in the low 20s. And the reason why is just because, again, my thesis has been the central planners and the central banks literally can't afford $20 oil. And the problem with $20 oil is a banking problem. And we know the banks are large shareholders of the Federal Reserve. And so what Goldman says, what J.P. Morgan says is what the Fed does. And you know, with them holding large amounts of energy, credit, and debt on their balance sheet, $20 oil is a very, very large problem for the banking system, inflationary expectations, which is what the Fed and the government need, and all those types of things. So betting that we hit $20 a barrel is betting that the Fed wouldn't ease if they needed to. It's betting Citadel doesn't ramp up the HFT algo machines. It's sort of betting against them, which has been a pretty bad bet since 2009. I mean, if the Fed, the government, if they need something, there's ways they can help create it. So I wouldn't be betting on $20 a barrel oil, but if it's not my base case, I wouldn't put anything past any market at this point. But I believe that the oil bottom is probably in around 25, 26, and I can see it retracing back into the low 30s potentially, high 20s, low 30s before we hit the summer driving season. This is still the seasonal build period, and we're in March, and that oil's done so well off the bottom. I think a little bit of a retracement wouldn't be unexpected here. But at the same time, it's held in there really, really well during the seasonal build period with Cushing and the maintenance capex at the refinery through this time of the year. You just get a natural build. Another thing is there's been, as we discussed last time about energy, there's $250 billion in capex costs cuts across the board in the energy sector. That spells lower production over the next year or two. And then with the compound average decline rate of the natural well production, when wells start declining, that also portends to have lower production looking out within a year. And so if oil goes to 20, we'll walk into a oil supply shock, and it'll look very similar to the 70s, where all of a sudden oil just goes ballistic. But I believe it started to rise, and I think it'll be fairly consistent. I actually expect oil to be, at least by the election, I expect it to be higher than it is now.
Just looking at what has happened with the stock market, correlated to oil and how the stock market has come up with oil, it's hard to disagree with your thesis on this, that rising oil prices is good for the stock market, it's good for central banks, bankers, and the, growing balance sheets for these companies. So I tend to agree, or at least see very clearly what it is that you're saying. And excellent analysis on that, Nicholas.
It's an interesting construct, Kenny, because if you think about it, when oil initially started going down, the menu with mainstream media and outlets was low oil prices is great for the economy. It means more dollars in the pocketbooks of consumers, which means they can spend more and they'll have more discretionary spending. Well, that never happened because their discretionary spending has been pinched with healthcare costs, the rising inflation and rents around the country. And then, we know about, college debt being a burden on people graduating and having high leverage and not high incomes with their bartenders and waiters jobs. And so there was never really any big boost to consumer spending. But clearly lower oil prices helped the economy from completely getting derailed and stagnating. But it didn't help. And so it got to a point where oil became so low, and the price was so low that it became problematic for the economy and for capital markets, not just here but around the world. But it became a problem for capital markets, which is why energy rising has been good for the stock market. But again, you just go back to what fuels this economy, and you need ever-increasing rising debt. That is what creates money, and you need that to forever grow. And when it stalls out just a little bit or falls, everything falls apart. And so it just got to a point, and that's why I don't believe oil hits certainly not in the 10s or low 20s, because I believe a red flag, a false flag event will happen before we really start to see those levels. And that's why I believe that we've seen the bottom. But I think that a retracement is, would be completely natural at this point. But it just got to a point where oil was actually a problem for the economy and for capital markets, even though it gotten so low. And you see the massive amounts of layoffs still transpiring in the oil sector, and that can't possibly be good for the economy. So you have rising costs, and you have massive layoffs. And the one sector that's created the most actually, if you took out the net full-time jobs of the energy sector in the shell, there would have been no full-time job gains since 2009 without energy. So you start to lose that with the low energy prices, and then it's really it's going to be very difficult times. And so the rising energy prices, rising all boats, is really no surprise to me at all.
Nicholas, I want to move over into precious metals and ask you, starting off with gold here, and what we're seeing here in 2016, gold is hitting 52-week highs. This is unlike what we've seen historically when we've had those, periodic rallies within this long-term bear market here. I just want to get your thoughts. I mean, are we in the green here for gold going higher? And, how are you playing it? What are your thoughts on it?
Well, how I'm playing it is I actually think that people who don't believe in owning gold or silver as a part of their portfolio, I truly feel bad for. I mean, and just because Ray Dalio once said it, and I'm a big, fan of Ray Dalio, but he said, if you don't own gold, you don't know history. And I'd say the same thing. I completely believe that would be true. If you don't own gold, you don't know history. And especially if you don't own gold, and when I'm talking gold, often you can just insert silver in there too, gold and silver. But when you look at gold as a percent of the monetary base, it's historically sold really, really closely towards what the monetary base is, or what the Fed's balance sheet is, essentially. And you can look over, decades and decades of history of this, and it's true. And when you think about this, like, the gold priced where the monetary base is today, it should be a minimum of $1,900 per ounce. Right around $1,900 per ounce would put it at its fair value towards the monetary base. The gold is undervalued towards the Fed's monetary base. you could just do a simple Google search for images and say gold, Fed's monetary base, and you'll see charts yourself that show this extreme correlation between the gold and the balance sheet of the Fed. And so gold is undervalued toward the balance sheet of the Fed, and this is the time to be continue to own it. If you own it, this is a good time to, I think, accumulate even more of it. There's a gold miner or two out there that probably would fit in a portfolio if you're not overexposed to the sector already, or if you own none of it. But I am a big believer in gold and silver in here, and I think history shows that anytime you're buying gold or silver when it's under the monetary base, valued lower against what the monetary base is, I think it's a great time to be accumulating it to preserve your wealth because you're buying it undervalued. And so that's what I believe with gold and silver. On a short-term basis, it's very interesting, but you had Craig Hemke on your show, and he talked about how there are no markets, they're all manipulated. And one of the things that's clear that he's spot on and 100% right on, but the correlation to the Bank of Japan and the yen with the dollar, and how correlated that is with the stock markets and also gold. But the biggest thing with the gold movement since 2011, and here's the irony, right? Gold is down since 2011, yet the Fed's monetary base absolutely exploded higher. And what changed from 2011 was every single time there was a big Bank of Japan policy meeting, gold would invariably have its big spikes down during those big policy meetings. Well, what happened this week, right? The Bank of Japan met. And guess what? Gold didn't go up this week, right? I mean, well, we're only on Tuesday, but last week the Bank of Japan, I should say, met, and what happened? Gold went down, right?
$50.
And so I think that's
yep.
Yeah, exactly. And so, sure enough, Bank of Japan meets. They have a big policy meeting. They come out with some information, and gold goes down. And that is definitely the agros and the HFPs, doing their little trick of sending gold down during a big Bank of Japan meeting. And I think it's the central planners, personally, I believe it's them colluding and working together, especially the ECB, the Bank of Japan, and the United States, because if you look at these countries where they're over-indebted, and the last thing that they need is gold skyrocketing. And so there's no one in worse shape than the Bank of Japan and Japan itself, with the most highly over-indebted on-balance sheet debt in the world. And, some serious banking issues, and then Bank of Japan basically monetizing and mopping up everything that's coming out, whether it's their stock market or their Japanese government bonds. And so it's no surprise that around the Bank of Japan policy announcements, that's when you see gold perform very poorly. But that's over with, and so I believe that gold will again settle down, and I think it'll start to rise again. But that's all short-term procrastinations. I'm not worried about that. I would be more worried about just not owning it, or when to accumulate more. And I think it's always a good time to accumulate gold. History showing that anytime it's below the monetary base. And so I'm a more patient 2, 3, 4 year type investor, where I look out 2, 3 years. That's where you gain your real advantage over the HFTs and the machines and the short-term nature of markets. Where you can gain advantage as an individual or as a portfolio manager is when you can look out 2 to 3 years and form theses based on what you see 2 to 3 years out, discounted back today. And I think gold's a good buy.
Nicholas, when it comes to the Dow to gold ratio, and something that we talked about, I think in our first interview, you expressed the concern for the Dow to gold ratio and the financialized assets being over financialized, and where the real value being undervalued is, and that ratio kind of gives a good correlation for what to expect going forward. Any thoughts on this here on March 15, 2016 regarding the Dow to gold ratio?
Sure. Well, when we did that, the Dow to gold ratio was around 16, and it's about 1382 now. So it has come down a bit. The interesting thing is if you look at, I think the 110-year average, the Dow to gold ratio is around 9.5. So just to get back to the average, it has a ways to go, which is another reason why you want to own gold in portfolios to offset or to potentially, have some nice capital gains against other assets that might not be performing as well. So I do believe in diversification. But yeah, the Dow gold ratio, I believe, is it's still going to be moving lower in companies like, Goldman Sachs, which I believe is the second largest holding in the Dow, right? That's the finest example of a paper asset ever, right? Because Goldman Sachs doesn't produce anything. They're an investment bank, and they push paper, and that's what Goldman Sachs does. And so gold against a financial asset like Goldman Sachs, at these metrics, I'll take gold any day when I look out 2 to 3 years. And so I believe that nothing has changed with that. It's gone from 16 down to 13.5 or so today, and I believe that will continue to contract in gold's favor as this moves forward. I mean, look, we have a soft economy right now, and we have a lot of uncertainty on the table, and then there's the political uncertainty now on top of it, and then you have gold undervalued and traditional financial assets overvalued. Those are some great values in the markets. The overall markets are vastly overvalued. Like if you look at the S&P 500, the last trailing 12-month earnings are $90 per share. That's a 23 times multiple. That's off the charts for the S&P 500. So the indexes are very, very overexpensive. I wouldn't be buying indexes in here. I'd be buying gold, and then I'd be buying select securities. But yeah, nothing's changed with the gold Dow ratio. I still believe that it's going to continue to contract as it has, and I believe that will favor gold over, say, the Dow.
Everyone, this is Nicholas Green of FMTadvisory.com. You can visit him there at FMT Advisory. Keep in mind, he is a money manager. He is a fiduciary advisor. And if you want to actually get his weekly research and articles, you can actually go and sign up at FMTadvisory.com. You can reach him there, and if you even want to have a conversation with him, the contact information is on the website. Nicholas, any closing thoughts here before we say goodbye?
No, thank you so much for having me on your program, and I can be reached directly at 888-649-6556. And I do apologize for listeners that do listen to me and are on my email list. Over the last week, I was on a small trip, and I've also been flooded with a lot of work and people requesting consultations, and so I've been a little slow on the writing, but I will definitely be writing a lot more over the next couple of weeks, and so people can look forward to that. And please join our email list at FMTadvisory.com. It's free, and start a communication with us.
Nicholas, thanks so much for coming on the show with me today. We'll talk very soon.
Thank you very much for having me.